In this final chapter, we will look at the basic features and risks of the following financial products: pensions, loans, mortgages, and life assurance. A pension is an investment fund where contributions are made, usually throughout the individual's working life, to provide a lump sum on retirement plus an annual pension payable thereafter. State pensions are offered by the state to retired people to provide them with the funds necessary to sustain themselves following retirement. These pensions vary from country to country. Corporate retirement schemes or occupational pension schemes are run by companies for their employees. The main advantages of these schemes are: employers fully or partly contribute to the fund. Running costs are often lower than for personal schemes, and the costs are often met by the employer. And the employer must ensure the fund is well run, and for defined benefit schemes, they must make up any shortfall in funding. Finally, private pensions or personal pensions are individual pension plans. They are defined contribution schemes that might be used by the self-employed. They could also be used by employees whose employers do not run a corporate retirement scheme. Private pensions might also be used in addition to an existing pension scheme. An example of a private pension scheme is individual retirement accounts or IRAs, which are found only in the US. There are three types of borrowing: overdrafts, credit card borrowing, and loans. The costs of borrowing vary depending on the form of borrowing, how long the money is required for, the security offered, and the amount borrowed. Loans can be subdivided into two groups: secured or unsecured. A secured loan is one in which the borrower pledges some asset as collateral for the loan. The collateral could be in the form of, say, a property or a car. The loan then becomes a secured debt owed to the creditor, who provides the loan facility. In the event that the borrower defaults, the creditor takes possession of the asset used as collateral and may sell it to regain some or the entire amount originally loaned to the borrower. On the other hand, the unsecured loan is not linked to the item that is purchased with the loan. Consequently, if the borrower defaults, it can be difficult for the lender to enforce repayment. The usual mechanism for the unsecured lender to enforce repayment is to start legal proceedings against the borrower. A mortgage is simply a secured loan typically provided to finance the purchase of a property. For most people, their main form of borrowing is their mortgage on their house or flat. Mortgages tend to be over a longer term than unsecured loans, with most mortgages running for 20 or 25 years. If secured loans are not repaid, the lender can repossess the specific property that was the security for the loan. Mortgage applicants are assessed in terms of income and employment security, existing expenditures such as utility bills, other household expenses, and school fees, the size of the loan in relation to the value of the property being purchased, which is referred to as the loan-to-value ratio, and the size of the loan in relation to the applicant's income, which is referred to as the loan-to-earnings ratio. There are four main methods by which the interest on a mortgage may be charged: variable rate, fixed rate, capped rate, and discounted rate. Because of the spectacular performance of property prices in many parts of the world over the last 30 to 40 years, property is seen as a reasonably safe investment that should provide reasonable returns as long as the asset is held for a considerable amount of time. Furthermore, there is the additional attraction that any capital gains made on your principal private residence may not be subject to any capital taxes, such as capital gains tax. Life assurance and protection policies are designed and sold by the insurance industry to provide individuals with some financial protection in case certain events occur. Although product details vary from country to country, the general principles tend to be consistent. A life policy is simply an insurance policy for which the event insured is a death. Such policies involve the payment of premiums in exchange for life coverage. This premium is a lump sum that is payable upon death. There are two types of life cover: the whole-of-life assurance and term assurance. A whole-of-life policy provides permanent cover, which means that the sum assured will be paid whenever death occurs. Instead, a term assurance policy pays the premium if death occurs within its specified term. To summarize, these are the 4 key points to this chapter. 1. A pension is an investment fund where contributions are made usually throughout the individual's working life to provide a lump sum on retirement plus an annual pension payable thereafter. Pensions could take the form of state pensions, corporate retirement schemes, and private pensions. 2. There are 3 types of borrowing: overdrafts, credit card borrowing, and loans. Loans can be subdivided into 2 groups, secured or unsecured. 3. A mortgage is simply a secured loan typically provided to finance the purchase of a property. 4. Life assurance and protection policies are designed and sold by the insurance industry to provide individuals with some financial protection in case certain events occur.